Hey everybody, Signet here with the Bullish Bears. So we're going to continue with this futures video series and we're going to look at the open range. This is one of those trades that can be done on products other than the futures. We're just going to really dial into it though on the futures products. Keep in mind this is a universal trade. It can be applied anywhere. Now, a little background on the open range. It's been around for a long time, and there are a lot of different ways to do an open range trade strategy. When I first was introduced to it, it was a 1 hour open range. So the market opens at 9:30, and you wait for 1 hour to go by. So at 10:30, you then mark the highest point in that hour, and you mark the lowest point in that hour. Here on the chart in the white area, that's the regular trading hours. The yellow is the pre-market and the gray is the Globex. So in the regular trading hours, I want to know where 1 hour is at. That would be 10:30. So it's this spot right here. And in that time, what was the highest and what was the lowest point? Well, let's turn on the magnet. The lowest point was at the bottom of that candle, and so that's my first place to start. Okay, so now the two black lines represent the highest and the lowest point in the trading period within the regular trading hours, and that would be where I'd want to start my focus. Okay, so that would be an open range, a 1 hour open range. After I used that for a while, well, let me back up again. So the way I used to do it is I would wait the full hour and I would mark the high and I would mark the low, and I would not trade until that hour went by. But what I found was I was missing out on all kinds of opportunities because I was sitting and waiting to mark this period. So after a few months, I gave it a real good chance. I didn't want to shortcut anything. I was fair about it, and I gave it that time. And then afterwards, I decided, I'm going to use something smaller than a 1 hour. So I went to a 30-minute time frame. Well, if we count that out, that would be the top of this doji. Okay, so now my bottom would be where the market hit the low in that first candle, and my high would be here, and that is a 30-minute open range. And that worked really good at first. So my rules again were not to trade in that first 30 minutes, and then afterwards I would look for trades. And you could see we had a great Busby right here, good opportunity to get in. But what I was finding is I was still missing out on opportunities. So I quit waiting for that 30-minute period. I would trade while I was waiting for the range to form, and I was still using that 30-minute range. It did get to the point though where I got curious and started marking a 5-minute range. It's a very aggressive open range strategy, but the success rate on it was really good. So now what I worked myself into was looking at the first 5-minute candle, marking the highest high and the lowest low, and then identifying trade opportunities after that. On Thinkorswim, there are indicators that can do this for you, and perhaps the trading platform you're on might have that opportunity. But you can just do it yourself. You just set your chart to a 5-minute chart and then mark the candle low and the candle high, and you have your open range. And from that, you start to look for trade opportunities. In this example that we have right here this morning on the ES, it did break to the upside. We would have been looking for a Busby to form, but since price didn't get far enough away, then we don't even consider that we had an opportunity here for the Busby. We would have needed to see price actually break away from the range and come back down, and it really never did. This candle opened while still touching this. It opened and closed, still touching the open range. The next one, we didn't get anywhere, and then we started to get that redness. Okay, so that never gave us a Busby. We did get a Busby down here, and there was our opportunity to look for a short entry. Okay, and just like that, we can start to clean things up and say very definitively, I know exactly what I'm looking for. I know exactly what I want to see. And when those conditions are met, I can take a trade. Now, one thing that we always want to focus on is what does it look like if I'm wrong? Okay, so if this is my open range and I'm looking to go short, how far would I let price come up into this area before I decided that perhaps I'm wrong and that it's not going to go down? What would that look like? What does wrong look like? And then when we make that decision, how far away is that, and is the stop enough to to fit my account? Am I willing to stomach that much loss? So here you might have gotten in right at the open range and taken all of this heat. And depending on your account size, you might not have been willing to take that kind of heat. If you are not willing to take that kind of heat, then you got to ask yourself, okay, should I not use the resting order? Maybe let price actually get up there, validate that that range is going to hold, and then pull the trigger after it starts to move back in the other direction. So instead of using a resting order, we would look to get in with order flow and with the momentum of price moving back in the other direction. Here right now, immediately as I'm talking, price pulled back. And we could be looking at the same situation all over again and asking the same question. Can I go short here? If I do decide to go short, how much would I let it come up into this range before I decide that I'm wrong? What would be my boundaries, my line in the sand? We could look at this candle here and say these three candles are forming a very near-term exhaustion area. If I wanted to go short, I could look to put a stop above this, and then again I can ask the question, is the distance between this entry and above this line more than I'm willing to stomach? If it is, then I can't get in here. I need price to get closer to this black line. And then if price doesn't get there and it starts to roll over, well, I'm already biased to the short side. I could then decide, okay, it's going down. That was my opportunity. I'm selling from the highs and not from the lows. I'm going to go ahead and join this trade. And then you could look to put your stop in this area because it would have already validated and you now have a confirmed spot. So we don't want to just use some immediate rubber stamp answer of, well, I'll always risk 2 points, or I don't ever want to risk more than 4. You need to look at the market conditions and then ask yourself, does my trade still fit? Where is my bias? What does wrong look like? And where could price go where I'm still right, but I'm not willing to hold on to that kind of loss? Okay, so like right now, price should not come up in this area. And if it does, we'd really have to evaluate, should I still be short? If it's coming up here, am I still right? Because if I am, I'm willing to hold that. But if this starts to prove me wrong and it gets in there, it doesn't matter what my stop is. If I'm wrong, I need to get out of that trade or not get in at all. So back to the open range. On the ES today, we had the open range entry here with the Busby, and it did get a little wicky. It would not have been a trade with no heat, but it was still a good trade. That would have been a great opportunity. You're going to find that on equity products, this is a really great way to find something to trade in the afternoon. So in this situation, we could be looking at this and say, okay, I might have been stopped out here because maybe I got in at the line, took the heat, didn't like it, quit the trade, but you could have got back in. Okay, so if you do get stopped out of a trade because you got in too soon, or you didn't time your entry right, don't let it run away and then complain, oh, I missed my trade. If only I'd have stayed in. Get back in. If you still believe that the trade is valid, if you still believe that you're right, don't let it run away without you. Get back in again. Now, that re-entry has often been called the 84% rule, and I didn't name that entry. It's not mine. That phrase of being the 84%, but that's typically what it's called. and that's the logic behind it, that perhaps our entry was a little too soon, a little too early, and
Order
we're looking
filled.
to make sure that we get back in and join that trend and not get left behind. So kind of keep that in mind. You can get back in. You don't have to just take the loss and watch price run away without you. So let's go look at another product, see if we can find any more of those open ranges with a really good entry. The Russell gave us one. The opportunity to get in was a very, very quick opportunity. If you didn't have your order waiting on the dome, you might not have gotten filled. So here's the 5-minute candle. We go from the bottom to the top. Notice the breakout here to the downside. Now, I personally don't like to trade a breakout. And mainly it's because where would my stop go? In this red area, it's like standing right in the middle of the interstate. Price can easily come back in this range, and it doesn't owe you any sort of support or resistance. So as it's breaking to the downside, I would not be interested in getting in here. Depending on the kind of trader you are, you might look at that and say, well, I absolutely would get in there. That's fine. Breakout trading is very popular. If that's what you're interested in doing, great. Don't let me discourage you from that. Please, if it works for you, do it. I've just found that I've never really been comfortable in a breakout. They fail 80% of the time, and there's just nowhere to put the stop. Okay, so for me, that just doesn't work very good. On this open range here that we've got defined, the Russell came back up and tagged the bottom of that open range, took just a little bit of heat, and the move was on. You wouldn't have to put your order on the dome. You could see that long wick, that strong smack reversal right there, all the selling pressure showing that your trade is valid, and on the next candle, you could have jumped in and taken that for a run. Okay, the breakout logic still applies also from the bottom of this candle, so that if you are that kind of trader and you weren't yet in the trade, you could have looked to get in at that point, right, as it came and crossed back through. So you can use the open range not just for trade opportunities, but also to get a bias on the day. Are we bullish? Are we bearish? Are we just maintaining? And it can really clarify for you where your trades are. Let's go and look at some equity products here. So here's Schwab, Charles Schwab, and we've got the open range. We need to turn on the overnight trading session, extended hours. And so here's the 5-minute open range. I don't see a trade opportunity from it. It broke out of the open range and then it fell right back in. All right, so we'll go find another product. Let's see if we can find, here's PayPal. So PayPal offered an opportunity. This is a very sloppy chart, but I think it's good to represent live trades and not just show all the very beautiful, very clean opportunities, right? So this finally broke to the downside after a lot of struggle. It would have been difficult to try to trade that. Maybe if we roll back to another morning. Here's the 5-minute. It didn't quite validate at the bottom of that range. It left a bit of a gap, but it stayed above the open range all day. The opportunities were there. The open range breakout is a really great trade strategy. You don't always have to trade a breakout though. The ES yesterday gave us an open range and then it stayed inside it almost the entire day. So from a standpoint of just taking reversals back and forth, that was also something that a lot of traders like to focus on, just trading from high to low and from low to high and back again. And we had those opportunities yesterday in the ES. Here's the top of the open range and there's the bottom of the open range. And if I throw it across the screen, you can see we had multiple opportunities through the day to trade this. And if we were looking for a Busby, if we were looking for that breakout, it failed every time. So we would have avoided getting stopped out just by waiting for the Busby to complete and to validate. Since it never validated, we never had an entry, we would have avoided getting stopped out on those breakouts. We would have had very clean high to low and low to high trade opportunities the whole day. So there's a lot of different ways to trade the open range. There's a lot of ways to use it, whether you're just trading reversals or you're trading the breakouts. And I encourage you to do a lot more work on your own to decide which one you really like. For me, the 5-minute is very comfortable. I will trade within that first 5 minutes, but more often than not, I'm willing to wait, give it 5 minutes, mark the high and the low, and then use that for my bias through the day. So guys, I appreciate your time, and I look forward to seeing you at the next video.